Welcome to the Money Mindset Podcast. Here we break down finance, investing, and smart money strategies in a simple way.
Have you ever wondered why some people can start with almost nothing and just quietly build massive wealth, while others work tirelessly for decades and remain totally stuck?
Oh, yeah. I mean, it's the classic frustration, right? Doing everything you're supposed to do and still getting nowhere.
Exactly. Well, welcome to today's deep dive. Our mission today is to unpack some excerpts from this really fascinating piece called The Architecture of Capital Recycling.
It is a great text, really eye-opening stuff.
It really is. And we've tailored this specific deep dive for you, the listener, as a sort of shortcut, a way to understand this hidden wealth building system that fundamentally changes the math on how money is accumulated.
Yeah, because it's definitely not what we're taught in school.
Right. So, okay, let's unpack this, because the source material drops this massive twist right in the opening chapter.
Oh, the part about what actually builds wealth.
Yes. The secret to bridging that wealth gap isn't like working 80-hour weeks. It's not a lucky stock pick. And it is definitely not day trading crypto.
Definitely not.
It's this highly structured, almost architectural approach to how money actually moves.
And I think that's why it completely reframes the objective. I mean, if you've ever felt that underlying frustration of following all the traditional financial advice.
Like maxing out the savings account.
Exactly. Maxing out savings, budgeting meticulously, clipping coupons, and you still feel like you're just running on a treadmill. Well, this text validates that entirely.
It really does. It basically says, hey, you're not crazy. The system is just different for the ultra wealthy.
Right. They fundamentally do not use the same financial physics, if you want to call it that, as the average person. But to truly grasp this hidden architecture, we have to establish the baseline first.
Yeah, we have to talk about what everyone else is doing wrong.
Exactly. We have to deconstruct the cycle that traps like 99% of the population.
Which the text calls the transactional trap. And I mean, the cycle is universally familiar to all of us. You work, you earn a wage, you spend on your living expenses, and maybe, just maybe, if you're disciplined, you set a little aside to invest.
But the fatal flaw is how that investing happens.
Right. Because you buy shares in a mutual fund, or you buy some gold or a piece of land, and your entire strategy basically boils down to just crossing your fingers.
Hoping the line goes up.
Yeah. You are passively sitting there, hoping the market price of what you bought simply goes up, so you could eventually sell it for a profit. It's like, okay, think of it like this. It's like buying a single painting, right?
Okay, a painting.
When you just hang it on your wall and stare at it, hoping someone comes along in 10 years and offers you double what you paid. I mean, it's totally passive.
That is a perfect analogy. That passive anticipation is the absolute hallmark of the transactional mindset. You're basically relinquishing all operational control to macroeconomic forces that you cannot influence.
Right, you're just a passenger.
Exactly.
Right.
If you buy an asset purely for appreciation, it's essentially dead capital while you wait. But the author contrasts this with the mindset of institutional wealth. The ultra-wealthy don't think in terms of isolated transactions.
They aren't just trying to buy low and sell high.
Yeah. No, they think in terms of systems. Their primary objective isn't capital appreciation at all. It is the absolute control of cash flow.
Cash flow. Which brings us to the specific vehicles they use. Because the source text isolates three specific ones: multifamily rental properties, middle market dividend-generating businesses, and private lending structures.
And notice what those three have in common.
Well, it isn't that they're trendy or glamorous, that's for sure. I mean, middle market businesses.
Right.
Not very flashy.
No, not at all. But they are productive. They generate regular, predictable revenue simply because you own them.
Right. And that totally changes your relationship with the asset.
Completely. Because when you rely on appreciation, like your painting analogy, you eventually have to sell the painting to realize the gain.
Yeah, and once you sell it, the asset is gone. You have to take that cash and start all over again.
But when you acquire assets for cash flow, you're building infrastructure.
Yes.
You retain the asset, and it just pays you a continuous dividend. It's the difference between hunting for food every day versus dating a farm.
Wow. Hunting versus farming, I love that. Which actually brings up a critical checkpoint for you listening right now. If you look at your own habits, your own portfolio, are you just participating in investing? Or are you actually building wealth?
Are you a hunter or a farmer?
Exactly. Are you just throwing capital over the wall and hoping someone pays you more for it in 10 years? Or are you engineering a system? because the architecture of capital recycling argues those are two completely different sports.
They really are.
But, okay, here is the logical hurdle I hit while reading this.
Okay, let's hear it.
If the goal is to buy these cash-flowing assets, like a massive apartment building or a manufacturing business, I mean, those require massive amounts of capital.
Oh, yeah. Millions, usually.
Right, so how do these investors keep acquiring more of them without eventually just running out of money, draining their own liquidity?
See, that is the exact threshold where average investors stall out. And it's exactly where the wealthy deploy the core mechanism of this entire text.
The capital recycling.
Yes. The author outlines this 5-step system called capital recycling. And the mechanics of it, I mean, it completely flips traditional debt philosophy on its head.
Okay, here's where it gets really interesting, because the math behind these 5 steps is just wild. Let's break this down meticulously for everyone. Step 1, acquire a cash-flowing asset.
Right.
Let's make this concrete. Say you buy a $1 million apartment building, and you put down, say, $200,000 of your own money.
Perfect example. So you've got your asset. Step 2 is allow it to grow and produce income.
So you improve it.
Exactly. Over the next few years, you improve the property, you optimize the management, maybe you upgrade the units, and you gradually increase the rents.
Which increases the value.
Right, because commercial real estate is valued based on its income. So the income goes up, the overall market value of the building goes up. Let's say it's now worth $1.5 million.
Okay, wait, stop right there. Because in the transactional trap we talked about earlier, this is the exact moment the average person pops the champagne, right?
Oh, 100%. They think they won.
Yeah. They decide to sell. They bought for $1 million, it's worth $1.5 million. So they sell it, they pay massive capital gains taxes, they pay a 6% broker fee, and they walk away with whatever is left.
And in doing so, they kill the golden goose.
They just chalk down the tree.
Exactly. They completely sever their cash flow. Which brings us to step 3, which is really the engine of this entire strategy. Unlock the value.
Without losing ownership.
Crucial point. Yes, without losing ownership. Instead of selling the asset, the wealthy investor goes to a bank and does a cash-out refinance.
Okay.
They borrow against that new $1.5 million value of the building. Let's say they pull out $300,000 in cash.
Now, wait a second. If you were listening to this right now and thinking, wait a minute, borrowing against a property, isn't that just taking on massive debt?
It sounds terrifying to most people.
It does. Because we are always told debt is bad. We're told it's a liability. So how does taking out a new massive $300,000 loan help build a system instead of just, drowning someone in debt?
What's fascinating here is the text demands we separate productive debt from consumption debt. This is a huge distinction.
Take that down.
Well, when society tells you debt is bad, they are talking about consumption debt. That's, using a credit card for a vacation to Hawaii or financing a luxury car.
Stuff that goes down in value.
Exactly. That money leaves your ecosystem, buy something that depreciates, and the interest just bleeds you dry. But in capital recycling, the original asset, our apartment building, is still generating monthly rent.
Right. The tenants are still paying every single month.
Precisely. And the key mechanism, the actual math that makes this work, is the yield spread.
The yield spread.
Yes. Even with the new, larger loan, the rental income from the building is high enough to make the new monthly mortgage payment to the bank, while still leaving a margin of positive cash flow for the owner.
So the asset pays for its own debt.
Exactly. You aren't paying that loan out of your salary. The building is paying it.
Okay, let me just make sure I'm wrapping my head around the mechanics of this, because it's nuts.
Yeah.
I put $200,000 into the building initially.
Yeah.
Because I grew its value. I just went and borrowed $300,000 against it.
Right.
And that cash, that $300,000 is completely tax-free, right? Because the IRS taxes income, not loans.
Exactly. It's not income, it's debt. So no taxes.
Wow. Okay, so I now have my original $200,000 back in my pocket, plus an extra $100,000. And I still own 100% of the building.
Which is still putting positive cash flow into your checking account every single month.
That is just, it feels like a cheat code.
It's the exact architecture the ultra wealthy use. You have effectively infinite returns on that specific asset now because none of your original money is left in the deal. Your capital has been successfully extracted.
Which triggers step 4.
Right. Reinvest. You take that $300,000 of untaxed liquid capital and you reinvest it. You use it as the down payment on a new income-producing opportunity, say a second apartment building or maybe a self-storage facility.
Okay, going back to the tree analogy, instead of chopping down your apple tree to sell the wood, which is what selling the property is, you keep the tree.
You keep the tree.
You harvest the apples, which is the rental income, to pay the bank. And you use the bank's money, which they gave you because your tree is so valuable, to go buy the seeds to plant an entire orchard.
That is a perfect visualization of the mechanism. You are using the equity of the first tree to finance the second tree. Now you have two trees producing apples.
Which leads to the final step.
Step 5, the ultimate wealth driver. Repeat the cycle over time. You stabilize the second asset, increase its value, borrow against it, and buy a third. The original $200,000 you saved is just moving from vehicle to vehicle.
The text actually refers to this as the velocity of capital. Basically, the faster you can safely cycle that same initial block of money through new assets, the faster your net worth compounds.
And you're doing it without needing a raise at your job.
Exactly. You aren't working harder at your day job to save up another $200,000. You are forcing the equity in your assets to act as your savings account.
And we also have to factor in the invisible tailwind of inflation here, which the text highlights brilliantly.
Oh, right, because inflation usually hurts the average person.
It crushes the average consumer. But when you take out a long-term fixed-rate loan to buy an asset, inflation is actually your ally.
How so?
Because over 10 or 20 years, inflation erodes the true value of the dollars you owe the bank. At the same time, it's driving up the value of your asset and the rent you can charge. So the debt actually gets cheaper to service every single year.
That's incredible. I'm actually looking at a quote from chapter 4 right now that summarizes this beautifully. The author writes, and I'm quoting here, "The amateur obsessively tries to eliminate all debt to feel safe. The architect utilizes productive debt to acquire assets that hedge against the very system itself."
It is a profound paradigm shift. Really changes how you see the world. But I mean, we do need to address the reality of execution here.
Yeah, the risks.
Right, because this isn't some magical money machine that works without risk.
I was actually just going to push back on that. Because if this is just a clean mathematical formula, acquire, grow, borrow, reinvest, repeat, why isn't everyone listening to this managing a $50 million portfolio?
Yeah.
Like, what is the catch? It sounds almost too clean.
The catch is gravity.
Gravity.
Yeah. The source text issues a very stark warning about the fragility of leverage. Capital recycling accelerates everything. It accelerates wealth creation, yes, but it also rapidly accelerates mistakes.
Wow. So if you mess up big.
Exactly. If you build this architecture on a weak foundation, the whole thing collapses like a house of cards. It requires highly managed risk and truly productive assets.
Give me a mechanical example of how this breaks down in the real world. Like, where do people actually ruin the cycle?
It usually breaks at step 3 or step 4. So a novice investor does a cash out refinance on their property. They get that $300,000 check from the bank. And instead of acquiring a new cash flowing asset, they do one of two things.
Let me guess. They buy a boat.
Basically, first they might use it for consumption. They buy the boat or they renovate their primary residence with like high-end finishes that don't generate any new income.
So they took on productive debt, but they deployed it into a destructive liability. I mean, the apartment building now has a heavier debt load to pay off, but there's no new income to support it if, say, vacancies rise.
Exactly. That's mistake number 1. The second mistake is they take that unlocked capital and they invest it into something highly speculative.
Like an isolated action.
Right. They put it into a volatile tech startup, or they buy highly leveraged crypto just trying to hit a home run.
And if that speculative bet goes to zero?
The capital is completely vaporized, but the debt on the original apartment building remains. So if the economy dips and rents drop, the original asset can no longer cover the mortgage. The bank forecloses and the cycle breaks instantly.
Yeah, the text mentions that exact scenario when it discusses risk management. It says the architecture requires strict discipline regarding the yield spread. Like, you cannot borrow money at 8% interest to buy an asset that only yields 6%.
It's basic math, but people ignore it.
Right. The math has to make sense on day one. And I think this highlights a massive trap I see everywhere online right now, especially with beginners.
Oh, trying to copy the strategies without the foundation.
Exactly. People try to copy these ultra-wealthy strategies, but they focus on isolated actions. They invest a little here, a little there, without understanding the entire connected flow. They never actually create a self-sustaining cycle.
Which is so common. And this raises an important question, really, about our cultural psychology when it comes to wealth building. Like, why are we so drawn to isolated, disjointed tactics?
I think it's because we just want the shortcut.
Yeah.
We want the shortcut without having to build the structure. Someone sees a billionaire using debt on social media, so they go take out a massive personal loan.
But they don't have the cash flowing asset to support it.
Right, they are buying the bricks, but they have absolutely no blueprint for the house. They completely miss the connected flow that makes it safe.
And when those disjointed actions don't yield immediate explosive wealth, they just abandon the strategy entirely. Because let's face it, we live in a culture obsessed with get-rich-quick schemes.
Totally.
But the text specifically notes that true capital recycling is intensely boring from the outside. I mean, it is not fast.
Appraisals and spreadsheets.
Exactly. You are dealing with property appraisals, bank underwriting, lease agreements, debt service coverage ratios. It is incredibly slow and not glamorous at all.
But I love that point, because that boring repetition is exactly what makes it bulletproof. When you design a self-sustaining system, you completely remove luck and market timing from your wealth equation.
You're not relying on a hot stock tip.
Right, you aren't endlessly refreshing a stock ticker, praying a CEO makes a good decision. You are engineering a mathematical certainty over like a 20-year timeline. And the money is always active, even when you, the investor, are not.
That is the ultimate divergence between the two mindsets. I mean, when you chase money through your own labor, you're relying on your own energy, and your energy is finite.
Yet you get tired.
You will eventually get tired or sick, or you'll simply want to retire. But when you architect a system that attracts and recycles capital, you are relying on the mechanics of leverage and compounding.
But you never get tired.
Exactly. They're mathematically infinite. The system does the heavy lifting for you.
So what does this all mean? When we boil down everything we've explored today from the architecture of capital recycling, the core takeaway for you listening is a fundamental shift in identity.
A shift in how you view your role.
Exactly. It is a shift from asking, how can I earn more money? To asking, how can I control how my money moves? It's realizing that one group of people is just exhausted from chasing money and trading their time for dollars.
That's the transactional trap.
Right. While the other group acts like architects. They are carefully designing plumbing that forces money to flow, multiply, and recycle continuously.
And if we connect this to the bigger picture, once you understand the mechanics of unlocking equity and that velocity of capital we talked about, your entire understanding of wealth changes permanently.
You can't unsee it.
You really can't.
Yeah.
You stop looking at your finances as a series of disconnected buckets like, oh, I have a checking account here, a 401k there, a mortgage over there.
Right. Isolated things.
Yes. You begin to see it as a living ecosystem. The goal is no longer about hitting a specific dollar amount in a savings account. It's about building a robust, interconnected network of assets that constantly feed each other.
It completely redefines what a dollar actually is. Which leaves us with a final thought for you to mull over.
The big question.
Yeah. Think about the money sitting in your bank account right now. Is it acting like a stagnant pool of water, just waiting to evaporate into your daily expenses? Or could you start building the plumbing today to turn it into a continuous recycling waterfall?
That's the real challenge, isn't it? Building the waterfall.
It really is something to think about. Thank you so much for taking this deep dive with us today.
It's been great.
Until next time.